Hi students, in this video I will show you how to calculate variance for manufacturing overhead. Okay, this is a sample question. The data below relate to a company and it is a manufacturer of exercise equipment for the month of August. You see here the standard variable overhead rate is $6 per machine hour. Remember, manufacturing overhead can be divided into two categories: variable manufacturing overhead and fixed manufacturing overhead. This is the standard variable overhead rate, $6 per machine hour. So the allocation base is machine hour. And then standard quantity of direct labor is 2 hours per unit of output. Budgeted fixed overhead is $100,000, and then budgeted output is 25,000 units. These are budgeted or standard data, and these are data. These are the actual data. Actual results for August are as follows: actual output is 20,000 units. Actual variable overhead is $320,000. Actual fixed overhead is $92,000. Actual direct labor is 51,000 labor hour. This one is supposed to be labor hour because it is direct labor. So I think this one is also supposed to be labor hour. So this. Okay, so the question asks you to calculate variable overhead spending variance, variable overhead efficiency variance, fixed overhead budget variance, and fixed overhead volume variance. Okay, now let's see how to calculate variable spending overhead variance. To calculate the variable overhead spending variance, you have to use this formula. Variable overhead spending variance equal to actual hours. In this situation, the actual labor hours times the average variable rate or average variable overhead rate minus the standard variable overhead rate. So now we do this. What is the actual labor hours? So you check the actual data. The actual labor hours is 51,000. So you just show the 51,000 labor hours, and then the average rate of the actual overhead rate. Actual overhead rate, to calculate the actual overhead rate, you have to use the actual data. So the calculation is the actual variable overhead cost. Actual variable overhead cost 320,000. 320,000 divided by the actual labor hour. Actual labor hour is 51,000 hours. 51,000 labor hour. And then minus the standard variable overhead rate. Standard variable overhead rate can be seen here. The standard variable overhead rate is $6 per labor hour per hour. So the number here is $6. So now you can calculate the variance now. Use your calculator and you will see that the thing is like this: 51,000 labor hour times $6.27 minus $6. Okay, the answer is 13,700. $13,700 unfavorable. Why unfavorable? Because the actual overhead rate is higher compared to the standard overhead rate. Okay, this is straightforward. Okay, the second question is, the question asks you to calculate variable overhead efficiency variance. To calculate this variance, you have to use this formula: standard overhead variable overhead variance times actual labor hour minus standard labor hour. Now, standard overhead variable rate is this one. The standard is $6. So $6. The actual labor hour is equal to this one. This one is the actual labor hour. So the actual labor hour is 51,000 labor hour. How about the standard hour? The standard hour, to calculate the standard hour, is like this. The standard hour, according to the standard, 1 unit of product is, the standard for 1 unit of product is 2 hours. So 1 unit 2 hours. And then during August, 20,000 units of product have been produced. So 2 hours times 20,000 units product. This is the way to calculate this number. The standard hour. Standard hour means the standard labor hour related to the actual number of production in August. So the thing is like this. So $6 times 51,000 labor hour. This one, if you calculate, sorry, this one is supposed to be 20,000 units. According to the data, the actual production is 20,000 units. Okay, so 2 labor hour times 20,000 units equal to 40,000 labor hour. So the answer for this is this one minus this one times 6. So $66,000 unfavorable, because the actual is higher compared to the standard. So $66,000 unfavorable. Okay, this is also, I hope, easy to follow. Okay, now, and then number 3, the question asks you to use this data and calculate the fixed overhead budget variance. Fixed overhead budget variance. So the formula to calculate the fixed overhead budget variance is actual fixed overhead minus budgeted fixed overhead. Okay, let's see. Actual fixed overhead is the actual data. So you have to refer to this this set of data. So actual fixed overhead. So you can see here the actual fixed overhead is 92,000. So 92,000 minus budgeted fixed overhead. So what is the budgeted fixed overhead? The budgeted fixed overhead, you have to check this table or this set of data. So the budgeted fixed overhead is $100. So 92,000 minus 100,000. So you can see here the difference is 8,000 and it is a favorable variance. Why favorable? Because actual fixed overhead is lower compared to the budgeted fixed overhead. Okay. And the last one, for overhead variance, you have to know how to calculate fixed overhead volume variance. Okay, to calculate fixed overhead volume variance, the formula is budgeted fixed overhead minus actual or applied fixed overhead. Budgeted fixed overhead minus applied fixed overhead. Now, the budgeted fixed overhead is clear. According to the data here, the budgeted fixed overhead is 100,000. So this is clear. 100,000. But the thing that you have to calculate is here. Applied fixed overhead. So how to calculate applied fixed overhead? To calculate applied fixed overhead, you have there are two steps. The first step, you have to calculate the POHR, predetermined overhead rate. And the second step is you have to calculate the standard hours for the applied overhead. Okay, so we do it one by one. So what is the POHR? The basic formula for the POHR is budgeted. Okay, see here, budgeted overhead divided by budgeted allocation base. Okay, what is the budgeted overhead in this question? Budgeted overhead is equal to this one. Budgeted overhead is $100,000. Okay, now what is the budgeted allocation base? The budgeted allocation base is the labor hour. So for 1 unit of product, the labor hour, the standard labor hour is 2 hours. And during the month of August, the budgeted output is 25,000 units. So the budgeted allocation base is 25,000 units expected output times 2 labor hours for every unit. Now you can calculate the budgeted overhead. Okay, I said it again. The budgeted allocation base is 25,000 units of production times 2 labor hour per unit. Remember, when you calculate the predetermined overhead rate, you have to show the budgeted overhead divided by budgeted allocation base. This is the budgeted overhead. This is the allocation base. The allocation base is 2 labor hours per unit product. For the month of August, it is expected that the production is 25,000 units. So this is the way to calculate the budgeted allocation base. So here now the answer is 100,000 divided by this one times this one. $50,000 labor hour. So 100,000 divided by 50,000 labor hour. The budgeted or the predetermined overhead rate is equal to $2 per labor hour. Now you know the POHR. Now you calculate the applied fixed overhead. Applied fixed overhead. Okay, how to calculate the applied fixed overhead? Remember how to calculate applied overhead for a job or for a production, for the production cost. So the way to calculate the applied fixed overhead is this one. POHR times standard labor hour. Standard labor hour allowed for this quantity of production. Standard labor hour allowed. Okay, POHR you have calculated here $2 per labor hour. Okay, standard hours allowed for the production. So how many labor hours allowed for the production of 20,000 unit? Remember, the actual production is 20,000 unit. So how many labor hours allowed for this? Or standard labor hour allowed for this. So the standard labor hour allowed for this is, for every 1 unit, the standard says for every 1 unit, only 2 hours. 2 labor hours allowed. So you use this one. So the standard labor hour allowed for this quantity of production is 2 hours times 20,000 units of production, of actual production. So the standard labor allowed is 2 hours. According to the standard, 1 unit 2 hours. So the actual production during August is 20,000 units. So 2 hours times 20,000 units. So how much? This one times this one is 40,000. 40,000 times $2, $80,000. Okay, now you have calculated the applied fixed overhead. The way to calculate it is, first you have to calculate the predetermined overhead rate. After you know the predetermined overhead rate, now you can calculate the applied fixed overhead. How to calculate the applied fixed overhead? Predetermined overhead rate times the standard labor hour allowed for the actual quantity of production. So $2 times 2 hours for 20,000 unit of actual production. So the answer is 80,000. Now you can solve this calculation. Budgeted fixed overhead is 100,000. Applied fixed overhead is 80,000. Okay, now what is the answer for this? The answer is 20,000. 20,000 under applied. According to this textbook, there is no favorable or unfavorable answer. Just whether the situation is under applied or over applied. Thank you very much. I hope this video helps you to know how to calculate variances for overhead. So I just want to show it again. Okay, so to calculate the variable overhead spending variance, you use this formula. Okay, and you will get the answer. And then to calculate the variable overhead efficiency variance, you use this formula. And then to calculate the fixed overhead budget variance, you use this formula. Actual fixed overhead minus budgeted fixed overhead. And then the last one is, if you want to calculate fixed overhead volume variance, you use this formula. Budgeted fixed overhead minus applied fixed overhead. To calculate the applied fixed overhead, you have to do two steps. First, you have to calculate the POHR. In this example, the POHR is $2 per labor hour. And then you calculate the applied fixed overhead. How to calculate the applied fixed overhead? POHR time standard labor hour or standard hour allowed for the actual unit of production. In this example, the POHR is $2. The standard labor hour allowed for the actual quantity of production is this. For every 1 unit, according to the standard, 2 labor hour. And during August, during the month related to the sample question, 20,000 units of product have been actually produced. So applied fixed overhead for this question is 80,000. Now you put the 80,000 here. 100,000 budgeted fixed overhead minus 80,000 applied fixed overhead. So the difference is 20,000 under applied. According to this textbook, there is no favorable or unfavorable. Maybe if you check other reference or textbook, maybe there is a term like favorable or unfavorable. Thank you very much. Do not forget to write your name and matric number in the comment section.